last month, June, CBK came to the public and said, hey, you guys, can you please lend me 50 billion? And guess what? Instead of the 50 billion, people were offering to lend to CBK as high as 76 billion shillings. In other words, CBK floated treasury bonds worth 50 billion and received bids worth 76 billion shillings, an extra 26%, like 150% bid. Yeah. And out of that, CBK accepted 66 billion shillings. So what does that tell you as an investor? It means that there's a still high demand for these treasury bonds, even though the rates have come down to 13%. The bids that were on auction this month rather, was at 13%. Yet, CBK still received an oversubscription and accepted more than whatever they were seeking to borrow from the public. They did accept 66B and rejected the other 10 billion. This borrowing was to be used for budgetary support. So what does the oversubscription and the acceptance of the 66 billion tells us? This basically means, or ideally means, that there's still a lot of investors are still willing to give CBK more money. And if you are CBK, if you are a seller of a product and you realize that there's over demand for that product, what are you going to do? The pricing? Increase the price. Okay? Any product for that matter. Whenever there's an over demand for a product, the prices go higher. So with the same breath, the bond prices are likely to continue going higher. And when the bond prices go higher, then the coupon rates are lower. The pricing, the bond price is not the same as the coupon rate. I need you to get those two different things. The bond price is not the same as the coupon rate. The price is what you'll be buying this paper at. For instance, if you go into the secondary market and you're buying a bond I had bought you're buying a bond from me, which I'd bought at a higher coupon rate, I'm going to sell that bond at a higher price to you. For 100 shillings, you're going to give me about 120 shillings. Okay? Now, with the oversubscription that we saw in this July paper, there's a high chance that two things are likely to happen. One, we are likely to retain this low interest rate regime for a very long time, maybe up to next year or 2027, or there's an opportunity that rates are likely to come down further. In fact, I don't know, maybe in the next MPC, the government, CBK, could probably reduce the interest rate further. And a reduction in interest rates, in as much as it's not something that we like seeing as investors at a personal level, of course, I would like to see rates coming higher so that I can lock in my investment opportunities at a higher rate. But a reduction of interest rate in the economy has a beneficial impact in the economy, which ultimately affects you at a personal level as an investor. When rates are lower in the economy, it means that business people, as a business person, you have easier access to loans. And your existing loans, the rates of your existing loans are going to reduce. And what happens when your interest rate on a loan reduces? Your guess is as good as mine. Of course, you pay less to the bank, okay? So even though the rates have been on a downward trajectory, it is a beneficial effect. The spiral effect the ripple effect is positive vibes for us all, for the economy, for you at the individual level. So then, what other investment opportunities would you be looking at in a low interest regime? You still need to have the treasury bond in your portfolio because that is where your safety net is. Of course, it's still classified as the low risk investment. Of course, it still offers you guaranteed cash flows. You still need to have treasury bonds in your portfolio. However, depending on your objective, your investment objective, if you have a long-term horizon and you have a risk appetite for it, I told you there is an inverse relationship between interest rates and shares or share prices. And sure enough, if you have been watching news, if you have been reading the papers, you have seen that the share prices in NSE has been and investors have been locking in money, locking in returns. So by the way, if you had watched my video sometime last year, I can't remember when I first did that, but when the Federal Reserve of US cut their interest rates, I told you that the stock prices in Kenya is going to go high. So anybody who watched that video back then and took heed of that and jumped in the NSU bandwagon has definitely made some money now. I shall do another video comparing the prices back then and what the prices have been right now, okay? Now, when rates are lower and you are seeking capital growth, then you might need to look at the high risk or the assets or the investment opportunities that has potential for offering higher returns. This is where we have our shares. This is where we have our special funds, the Mansa X, the Avocap, the OC Fund, and what have you. But do not forget the relationship between risk and returns. So I am not saying that stop investing in bonds. Yes, the bonds are still there to offer us the safety net, to offer us the guaranteed cash flows. However, if you're seeking to lock in high returns, if you're seeking capital growth, then this will be the time to now consider diversifying into the high return investments. Mansa X, Avocap, OC, Kuza Momentum, and so on. In fact, CMA has licensed a couple of special funds, yeah? But do your due diligence before you jump into any of these special funds. Tafadhali. In as much as the past history does not indicate what the future return is going to be like, don't forget to look at the performance records as well. Anyway, I just felt the need to urgently or briefly share with you my opinion on the July Treasury bond auction and the results that we have seen, and inform you also that if you're looking for capital growth, then you might need to consider investments that promise or that offer higher returns, though with the full knowledge of the risk-return relationship of every investment opportunity. What do you think about the bonds and the special funds? I don't even want to mention money market funds right now. However, money market funds interest rates, as a by the way, are definitely still going to reduce. Why? Because the T-bill is still low, okay? And does that mean that you need to stop investing in MMF or you need to stop saving in MMF? No. The money market funds still offers us the same function. The functions of the MMF has not changed. They have never been for capital growth. There's minimal return we get from them, but the main objective is liquidity, safety, short term. Can you save in MMF for 10 years? Yes, you still can save there for 10 years. But remember, your money will not grow with the same level as it would if you were to take up the high return, high risk, slightly higher risk investments like the special funds, the Mansa X, the Avocap, and OC, and what have you. Okay? So, how then do you know where to put your money? The bonds, the money market funds, the circles, or the special funds? This is where now you rely on what do you need to achieve. And if you find yourself in a scenario where you might not be able to make the right decision, or you are a bit confused still whether to take the special funds, whether to go into shares, whether to take the circles, the money market funds, the bonds, then you might consider engaging somebody who understands investments and can listen to your current circumstance and can give you a guide on where to prioritize first, or which investment vehicle will suit your specific investment objectives. Okay? Don't listen to the people who tell you that you are not ripe for taking up bonds without knowing what you want to achieve. Okay? My name is Belin. Thank you for tuning in, and let's meet on the next video.